Gold is approaching a massive liquidity zone, and my primary focus today is a high-probability sell setup. We're looking to target the sell-side liquidity, resting down at 40.32, but there's one strict condition that has to happen first. While the retail market is just seeing random volatility, smart money is actively preparing their next macro move. In this explainer, we're going to decode the exact institutional footprint forming right now.
Right now, most retail traders are staring at the completely wrong level, essentially trapping themselves in early, unconfirmed positions. Let me show you exactly where institutions are actually targeting before the New York session even begins, and why those obvious levels everyone is watching are nothing more than engineered traps.
Looking at the hourly structure, we are aiming directly for that massive sell-side liquidity resting at 40.32. If you look closely, you'll notice these very clean, relatively equal lows forming here. To an algorithmic pricing model, that is an absolute magnet. But like I mentioned, there's a non-negotiable condition we need to see before we even think about entering.
So why 40.32 exactly? Well, this isn't just some arbitrary support line you draw on a chart. It represents a highly vulnerable pool of external liquidity. Basically, it's a massive cluster of retail stop losses. Institutional algorithms are going to look to aggressively pair their heavy, profitable short orders right at this exact level. Before we dive deeper, let's lay out the exact trading plan. Our overall macro bias remains strictly bearish. The primary entry zone we're watching sits uniquely between 40.78 and 40.85, heavily targeting that 40.32 level, with the protective stop loss resting safely at 40.9650. You need to keep this exact structural framework in mind as we break down the mechanics of why this actually works.
Now, if we zoom out to the 4-hour chart, the institutional narrative becomes crystal clear. You'll see that smart money utilized recent session expansions to perfectly sweep buy-side liquidity exactly at the 41.18 level. They deliberately engineered a brief fake-out above those older highs for one specific reason: to grab that resting liquidity.
See, when institutions push price above a key resistance level like that, it isn't a true breakout. It triggers a flood of retail stop losses, which instantly creates a massive influx of automated buy orders. Institutions then use those exact buy orders as counterparty liquidity to discreetly fill their own massive short positions. This aggressive sweep is what actually initiated the heavy distribution phase we're in now.
But here's the problem. This recent volatility wasn't random, and it definitely wasn't just technical. It was mathematically tied to macro catalysts. Specifically, the Bank of Japan interventions driving currency flows, the escalating geopolitical tensions in the Middle East, and the US dollar index aggressively rebounding above that 100 level.
Institutions actively use these high-impact macroeconomic events as a smokescreen, while retail traders are out there trying to trade the news and just seeing pure, unpredictable chaos. Smart money sees a highly precise delivery matrix. They use the surge in volume from these global events to secretly engineer liquidity and seamlessly complete the delivery of their macro order blocks.
Just look at the daily structure. Notice how price has been forming this massive, prolonged distribution phase ever since we fiercely rejected those 5,500 highs? The pricing algorithm isn't just guessing out there. It is relentlessly seeking out those discount extremes and the resting sell-side pulls at the bottom of the range to balance the books.
However, smart money may be targeting something completely different on the intraday scale. Are you prepared for the Judas Swing? Because this is where most traders get completely trapped by prematurely entering short positions during active down legs, right before the market violently reverses on them.
If you're not familiar, a Judas Swing is a false early session move designed specifically to trap retail traders on the wrong side of the market. We are fully anticipating a brief London or early New York session purge, a sudden spike back up into a premium pricing array to capture early short sellers' liquidity before the true expansion lower finally begins.
Dropping down to the 15-minute chart, we can start building our actual execution model. Looking at the current price action, you can clearly see the actively forming downside displacement. It's leaving unmistakable institutional footprints behind in the form of rapid, aggressive selling pressure that breaks immediate market structure.
The market is sending a warning signal right now. You absolutely must wait for this current leg down to finish and naturally retrace back into the fair value gap, that specific imbalance of price left between 4,078 and 4,085. We need to see a lower time frame market structure shift inside this zone to confirm the algorithm is actually ready to deliver.
So the most crucial takeaway for this setup is this:
Right now, there is no trade. Smart money confirmation has not yet appeared. If price currently sits mid-displacement and hasn't confidently retraced into our premium fair value gap, we sit on our hands, we preserve our capital, and we simply observe.
Now, once that critical confirmation does appear, this executable sell scenario offers a highly asymmetrical risk-to-reward ratio. By carefully entering inside that 40.78 to 40.85 zone, we can target internal swing lows at 40.50 to scale out partial profits, securing our risk, and leaving a runner for our main liquidity objective all the way down at 40.32.
But what will invalidate this setup entirely? This level becomes critical, and knowing exactly where your thesis is wrong is what separates elite institutional thinking from retail gambling. You have to have a hard line in the sand before deploying any capital, so let's carefully define our invalidation level.
This perfectly illustrates the psychological divide. Most retail traders are going to anxiously chase a direct, emotional collapse down to 40.32. They completely ignore the fact that a single candle body closing above 40.96.50 would instantly invalidate the immediate bearish order flow. Smart money doesn't chase momentum. They patiently wait for the premium gap to cleanly rebalance.
So to recap today's intraday analysis, remain fiercely patient for that premium rebalance before you execute any orders. Secure your partial profits at 40.50 to fund your risk and manage your capital strictly. Remember, a professional, institutional grade setup means risking no more than 0.5% to 1% of your entire account equity.
If you found the detailed insights in this explainer valuable, and you want to master institutional-style market analysis using ICT and smart money concepts, make sure to subscribe to ICT Market Theory. And if you'd like to actively trade alongside these exact setups, you can find the FXTM account link in the pinned comment below.
The external liquidity levels are mapped out. The underlying macro logic is clear. So the only question left is, are you willing to wait for the true institutional footprint to present itself, or will you let impatience turn you into the market's liquidity? Let the market organically deliver the confirmation to you. Trade safe and stay disciplined.